So in this session, we start solving a typical throughput decision-making question. We still use the same process we used in a limiting factor decision. So we are going to look at Pi PLC, and then we look at Happy Limited. There are two different variations of questions. We are going to look at how to deal with all such questions. So with this one, we are going to use a marginal costing system. We are going to use a throughput accounting systems for this question. And we are also going to try to use the throughput accounting ratio to work the same question. So you can use the same limiting factor approach, or you can use the throughput accounting ratio to work your contribution per hour or your factory return per hour. It all works. So let's look at Pi PLC manufactures two products. We've seen them, product A and product B. Okay, now it's zoomed enough. And then it said calculate the optimum production plan and the maximum profit on the assumption that in the short term, only material costs are variable using the throughput accounting approach. And it says calculate and interpret the throughput accounting ratio. Okay, so this is what we have. So I am going to do two approaches. Just as a recap, I'm going to solve it using limiting factor. That is using marginal costing. That's how most of your questions will come. So you solve it using marginal costing and solve it using throughput accounting. So I'm going to start A using their current production system or using marginal costing. So A, so using marginal costing, okay, marginal costing, okay, so that means that under marginal costing, all variable costs are still variable costs, including material. So identify the limiting factor. I told you that's the first thing you do. So identify the limiting factor. So now what we have here is that we only have machine hours available, right? Only machine hours available is what we have. So in that case, testing machine hours, that's my approach, testing machine hours. So we testing machine hours. What do we do then? So we have machine hours here. So required for production or available for production. So machine hours available for production. We have how many machine hours do we have available for production? It says we have 48,000. So how much do we require for production? Required for production. Now we have two products, right? So for product A, we need, it says we need 2 hours per unit. But how many units are we producing? It says we need 20,000 units under a just-in-time system. So if we need 20,000 units, that means we need 40,000 hours overall to produce. Then when we look at product B, it says we need what? 1 hour per unit to produce. So if 1 hour per unit, how many units are we producing? That's 10,000 units. So if 10,000 units, that means we have 10,000 hours overall. We put this together, that means we require 50,000 hours overall to produce. So if you require 50,000 hours and you have 48 available, that means there's a shortage of 2,000 hours, which means that the machine hours or the machine capacity is the limiting factor. So I said, therefore, machine hours is the limiting factor, right? So this is the same as throughput, the bottleneck, limiting factor or bottleneck, right? So this is how you are going to work it. It's the same thing for throughput. So I assume the same first step for throughput or marginal costing, it works the same. Now that we know this, now let's go into it. So now that you know that machine hours is the bottleneck, that means you have to what? Sync this. I get it. You have to try to what? Sync this and then calculate your contribution. Then calculate your contribution. So the next step is to calculate your contribution per unit. So this is marginal costing. So we need contribution per unit. Okay, you can go straight to your contribution per limiting factor, which will make it faster. So contribution per unit of bottleneck, it depends on how you want to go, or contribution per unit of limiting factor, depends on how you want to go. So if contribution per limiting factor, so now you calculate your contribution per unit, and getting your contribution per unit, what do you do? So you bring your product A and bring your product B. So how do we get this then? So an orange pencil. So you get your selling price, and your selling price for this is 25. We have 28 for B. Then we less our variable cost, not so marginal costing. So we less our variable cost. So variable cost, I think we have material cost, which is 8, and this guy being 20. We have labor costs, which is 5 and 2. Then we have variable overhead costs, that is 7 and 2. So we take all out from our sales. And what then do we get? So I think for product A, can work this out as 25 minus 8 minus 5 minus 7. That gives us 5 per unit as our contribution. And then when we come to product A, we have 28 minus 20 minus 2 minus 2. And that gives us 4. Okay. So now that we have this, we can get what? Our contribution per limiting factor. Okay. So we now divide by the limiting factor, also, which is the machine hours, which is our machine hours. So by dividing by machine hours, we know we have 2 hours for this guy and we have 1 hour for this guy. That means our contribution per limiting factor actually gives us 5 divided by 2 and 4 divided by 1. So this gives us 2.5 cedis per hour. This gives us 4 cedis per hour. So that means for every 1 hour, you can make 4 cedis. Against every 1 hour, you can make 2 cedis, 50 pesos. Which one is higher in ranking? So the next step is to rank. And when I rank, this is first and that is second. Okay, so that is your ranking, first and second. So once you've determined the ranking, the next step is to prepare an optimum production plan based on your ranking. So based on this ranking, let's prepare an optimum production plan. So my step 5 is my optimum production plan, which I told you is known as the profit maximizing output. Okay, so the same thing works here. So I will first start with my available hours. I know my available hours is 48,000 overall. Then I bring the product, then I bring the rank, then I bring the usage, right? Or the utilization. It all works. So the first in ranking was product B, right? Which was 4 cedis per hour. How many hours do we need overall? We know that for this product, we need 1 hour to produce, but we are producing 10,000 units. That means overall we need 10,000 hours. Can we take off from the 48? Yes. So if we are producing 10,000, that means you have 38,000 hours remaining. Also, so if you have 38,000 hours remaining, when we get to product A, which is the second in ranking, we only have 38,000 hours remaining. But if 38,000 hours, how many units of product A would we produce? Because we need to produce 20,000 units, which requires about 40,000 hours. But we only have 38. Into 38, if it may produce, saying how many units can it produce? So you can just take the 38,000 hours that you have and divide by the hours required, which is 2 hours. That means how many products can you produce? That's 38,000 divided by 2. That means you can produce 19,000 units. Not so? That's all you can produce. So you have no hours left. So you have been able to get your profit maximizing output, which is your 10,000 units for product B and 19,000 for product A, meaning that the 1,000 units left, if there's an external supplier who wants to produce it, you can outsource it to him, provided that his cost, are you getting it, is lower than your cost of production. So that's what we do when we are doing make or buy under limiting factor scenario. We'll look at that later. Now that we know this, what we need to do is to get our maximum possible profit. So how do we get our maximum possible profit? First of all, we need to calculate our fixed cost. Okay, so determine your fixed cost. So how do you get your fixed costs? So fixed cost, I know that it is fixed costs are always per the budget. Please remember this. It's always per the budget. Now, per the budget, the unit we wanted to produce was 20,000 units and 10,000 units. Okay. So that one we don't multiply by, this is under marginal costing. Under throughput is a different case. So under marginal costing, we know that fixed costs are not real, but if we are going to get our fixed costs, we want our budgeted fixed costs. And the fixed cost that we have here, we know that the fixed cost that we have for product A, it was what? It was 2 cedis per hour, 3 cedis per hour. No, it was 3 cedis per unit. And we are producing 20,000 units. So that means we have 60,000, also Ghana cedis. And then when we come to product B, it's 2 cedis per hour. Why do I keep saying per hour? 2 cedis per unit by 10,000 units. So that gives us 20,000. So 326, 2212. So that gives us 80,000 as our fixed cost. Please, we can't base this one because this one is conventional or traditional costing. We can't use the 19,000 and the 10,000. We have to use the budget. What was per the budget? Okay, so this is what we do. So what's our maximum profit? So that means step 6 is our maximum possible profit. The possible profit that we are expecting to actually make. Okay. And then we know profit is actually what? Your contribution minus your fixed cost. Now we've got fixed cost to be 80,000. So let's take our total contribution. Now, so and our contribution will be based on our profit maximizing output. Now, so for product A, we know that we are making a contribution. What was the contribution for product A? Contribution. Product A was 5 and B was 4. So contribution for A is 5, but we are producing 19,000 units. And for product B, this 19,000 is based on our production plan. Okay. So based on your production plan, 19,000 units, and this guy was 4 per unit, but we are producing what? 10,000 units. Okay. So 5 by 19,000. That gives us 95,000 for this guy. And then 4 by 10,000 gives us 40,000. So 95,000 plus the 40,000. That gives us 135,000 as our total contribution. So now that we have our total contribution, we less the fixed costs. That is 80,000. That is 80,000. So once we take it out, 135 minus 80,000 gives us 55,000. Okay. And this is our maximum profits. Okay. So that is it. So under a marginal costing scenario, yes, or bed for Obesan friend, the same Panam Catch and me class. Yes, a bed preference. Obesan free your friend. When na lucky. Yeah, me are not for me. Yeah, wait, yeah. I don't see me. Yeah, not for So the next one is in a throughput scenario. So in a throughput scenario, what will we do? You can follow the same process, but now you are going to use material as the only variable cost. So the limiting factor still remains the same, but material is the only variable cost. So how do you do this in a throughput scenario? So we know the limiting factor is the material, the machine hours. All right. Know that is the machine hours. But then now what we want to do is that we want to get the throughput return or the throughput. So that's step 2. Calculate your throughput return per unit, right? Your throughput return per unit. So I'm going to do 2 approaches. You can do the normal limiting factor approach, which is getting your throughput return where material is only variable cost, or you can calculate your throughput accounting ratio. It all works. So now I take A, I take B. Not so. I have my selling price 25 and I have 28. Now the only variable cost is my material cost, okay, which is 8 here, and then I have 20 here. So that means this guy 25 minus 8, I think that's 17. You have 17 as your throughput, and here you have 8 as your throughput, right? So that's your throughput or your throughput return. So now we need what? We divide by the limiting factor or the bottleneck hour. Okay? And the bottleneck hour is the machine hour. This one is divided by 2 hours. And this one is divided by 1 hour. That's all. So that means the next step is what? Your throughput return per bottleneck. That's all. So at this stage, you have 2 options. You can just calculate the throughput return per bottleneck and rank. It works, right? So now that you have this, 17 divided by 2 gives us 8.5 per hour. So that means for every hour, you make 8 cedis, 50 pesos per every machine hour used. And here you make 8 cedis per every machine hour used. So that means if you are ranking, B becomes the first in ranking. A becomes the first in ranking, sorry. Means A becomes the first in ranking. And B becomes the second in ranking. So you see, when we are using throughput, it changes from marginal costing. Material becomes the only variable cost. Make sure you never forget this. So now that we have the ranking, we can proceed to calculate our optimum production plan and allocate, getting our profit, maximizing output. But however, some questions may ask you to get what? Your throughput accounting ratio. If that is the case, we know throughput accounting ratio is actually calculated as what? Our throughput return per bottleneck. Also, so if you want throughput accounting ratio, so that means that you use the throughput accounting ratio to rank. So we know this is our throughput per bottleneck resource, so your bottleneck hour, which we have done up there as 8.5 and 8, over our what? Our factory costs per bottleneck hour available, right? Per bottleneck hour. So in that case, what we need now is that we've got the first part, which is the A. This is the A part we've calculated, okay? Which you can still rank and continue, or you can get your factory costs per bottleneck. Not so. So first of all, let's get our factory cost, our total factory cost. And then our total factory cost, remember that all costs apart from material are factory costs. So labor, other variable costs and fixed costs are all factory costs. So I'll first take my labor cost. So this working also, we get some marks in the exam. So A, I know that A, I have what? Labor is 5, but I'm producing 20,000 units also. And for B, the labor cost is 2. I'm producing 10,000 units. That means for labor cost, I have 5 by 20,000, 100,000, and 20,000. That means labor cost gives us what? 120,000 as factory costs. Okay. Now, when I go to other variable costs the same way, if I take A, product A, other variable costs are making what? Product A was 7, but we are producing 20,000 units. That means we have 140,000. Also, and for B, it was 2. We are producing 10,000 units. That gives us 20,000, meaning we have 160,000 for this. When we get to fixed costs, the same way, A, the fixed cost was 2. We are producing 20,000 units. And B, the fixed cost was also 2. We are producing 10,000 units. So this gives us what? 40,000, and this guy 20,000. Also giving us 60,000. So our total factory cost, by summing all this up, that gives us total factory cost of 120 plus 160 plus 60. That means we get 340,000 as our total factory cost. Now that you have your total factory cost, how do you get your throughput accounting ratio? We know that we have got our factory cost now. We need our factory cost per bottleneck. Factory cost per bottleneck. So we have to divide by the available hours or available bottleneck resource. So in that case, we know that this one we had 340,000 also. So you see the ranking we had up there. Even if you get your throughput accounting ratio, the ranking is not going to change. So factory costs, operating expenses per bottleneck is going to give us what? The 340,000 over our available 48,000 hours. Not so. That means this is going to give us what? That's 340,000 divided by 48,000. That gives us 7.08. 7.083. Okay. So this is our factory cost per bottleneck. So now the next stage is to get our throughput accounting ratio. So how then do you get your throughput accounting ratio? We know our throughput accounting ratio, we can get it also for each product. So we know we have product A, we have product B also. Now, we know that product A, our throughput accounting ratio actually becomes what? Our contribution per hour over our, what was our contribution per hour that we had? Okay, so it's 8.5 and 8. Okay, then we divide by, because this is fixed cost, it will always be fixed. It doesn't change for each product, 7.083. So we have this guy being 8.5, so this guy being 8 CDs. So we divide this by 7. Is it 803 or 8083? 7.083. 7.083 over 7.083. Okay, so we get throughput accounting ratio for each product. And you know when the throughput accounting ratio is greater than 1, the product is profitable. So this over 7.083. And that gives us 1.2, meaning it's profitable, right? And we have 8 divided by 7.083, which gives us 1.12. You see, both products are profitable, all right. But that is why we rank, okay? So your ranking, you realize that your ranking will not change. This will be first and this will be second. And from here, this is what you use to do your optimum production plan. So the next step after your ranking is to get your optimum production plan. So how then do you get your optimum production plan? It's the same way. So another way is that they will tell you to get your what? Your profit maximizing output. So for your optimum production plan, what we are going to do is that we are going to take our available hours now, and available hours was actually what? 48,000. So 48,000, then we have our product, we have our rank, We have our usage also, product rank and usage. So product, we have product A being the first in ranking. That one we required was 20,000 units. Can we do all? Yes, we require 2 hours and we are producing 20,000 units. Also, that gives us 40,000 hours. Can we use all? Yes, we can. How much is remaining? That means you have 8,000 hours remaining. So 8,000 hours, that is all we have available to use for the production of the next product, which is B, which is now second in ranking. So if each we are using 2 hours, 8,000 will give us how many units? So you just have to take your 8,000 over the 2 hours. That means you can only produce 4,000 units out of the total 10,000 units. Okay, that's your profit maximizing output. So to get your maximum profit, okay, you can get your total contribution or your total throughput contribution. And your total throughput contribution will be A. We know A's throughput is now going to be, that's the contribution that we had. And throughput contribution for this guy, I think, was 17, and this other guy was 8. Okay, so you can take your 17 CDs per unit times the total number of units. Here we can produce all the 20,000 also. And then for product B, it was 8 CDs per unit, but we can only produce 4,000. When we add this, that gives us our total contribution, which is 17 by 20,000, 340,000 plus 8 by 4,000. That gives us 372,000. Okay, so we have 372,000. Then we take out our factory costs also, or our total factory cost, which we had as 340,000. So take out your 340,000 total factory cost, and that gives you your 372 minus 340,000. That gives you 32,000. Okay, 32,000 as your maximum possible profit. Your maximum possible profit. Okay, so that is how you do throughput, okay, and get your maximum possible profits. It's just like the normal limiting factor. Straightforward from the throughput contribution per limiting factor, you can rank. But if the question requires the throughput accounting ratio, this is the approach you use to get the ratio, you rank, and then you continue.